Good evening, everyone. Thank you for joining us this evening. I'm Akila Shashidharan, Assistant Professor at Jindal Global Business School in the area of finance. I welcome you all for today's lecture, which is a part of ongoing inspirational lecture series organized by the Center for Research in Emerging Economies at the Jindal Global Business School of OP Jindal Global University. This evening, I have the pleasure of introducing to all our speaker, Professor Kate Phylaktis. She's a professor of international finance and director of the Emerging Market Group at Cass Business School, City, University of London. She previously held research and analyst position at the London School of Economics and the National and Commercial Banking Group, which is now called as Royal Bank of Scotland. Kate's main research and teaching interests are in international finance and emerging market finance. She's also interested in development of financial markets, the interaction of corporate governance and asset pricing, and the interaction of capital flows and corporate finance. She's the author of 45 articles published in the top finance and economic journals, includes Journal of Corporate Finance, Financial Management, Journal of International Money and Finance, Review of Economics and Statistics, and the Journal of Development Economics. She has authored 3 books, including The Banking System of Cyprus, Past, Present, and Future, a seminal book on the development of the banking system of Cyprus, and was the guest editor for the 4 issues of the Journal of International Money and Finance on emerging market finance. In addition to the teaching and doing research, Kate has been involved in policy advising, training, research, and consulting projects for a number of institutions, including IMF, Advisory Council, Warsaw University. She has also acted as a consultant to the Ministry of Education and Religious Studies in Greece and Ministry of Education and Culture in Cyprus, advising on the development of tertiary education. Kate has set up the Emerging Market Group in 2001, which is a forum for academic research on international exchange and financial market. She has also served as an associate editor of many journals, including Journal of International Money and Finance, International Journal of Financial Analysis, Emerging Market Review, and Pacific Basin Finance Journal. Professor Cates will be talking today on the topic capital structure in developing countries around the world. Are small firms different? Before I request Professor Cates to start the talk, there are few basic rules which I would request everyone to follow during the lecture. Keep your microphone on mute and webcams turned off all the time during the lecture. During the talk, in case if you have any question to ask, do feel free to raise in the Q&A or chat box. After the lecture, Professor Kate will answer the question. Professor Kate, thank you so much for accepting our invitation, and the stage is all yours.
Thank you very much, Dr. Aguila, for your kind words, and I'm very pleased to be amongst you and to be able to present you our work. The paper that I'm presenting today has been written jointly with Gulnur Muradoglu and Tuba Bas, and so I will be starting. Okay. Now, it's a fact that the leverage of small and medium-sized companies, usually known as SMEs in developing countries, is lower than the leverage of large firms in the developed world and in the developing countries. Just by way of motivation, let me give you what the size of the leverage is in our sample. The leverage for small and medium-sized companies is about 30%. For small companies, 46% for the medium-sized companies, compared to the 50% of large firms in our sample. So this raises the question whether the capital structure choices of small firms in developing countries are affected by the same factors as that of large firms. In most developing countries, the major obstacle to external finance for small firms is the availability of credit. So economic growth and the economic and financial environment of the country is very important for accessing finance by small firms. So in our paper, we examined the determinants of capital structure decisions of small firms in developing countries. Now, previous research on the subject, and a lot of papers have been written, have focused on large listed firms in the US, other developed countries, and a small number of developing countries. The studies on SMEs are mostly limited to European countries where the institutional characteristics are similar. Our main focus has been on the very small firms in developing countries, which are more representative of the corporate sector in those countries. So the two questions we will be trying to answer in this presentation are the following. Are the capital structure choices of small firms in developing countries affected by the same factor as those of large firms? And secondly, does the relationship between capital structure decisions and the economic financial environment and institutional characteristics vary with the size of the firm? Now, a lot of papers, as I said, have been written on the subject, and mostly on large listed firms. And just to give you some examples, is Titman and Wessels, 1988, Rajan and Zingales, 1995, Demirkul, Kunt, and Maximovic, 96 and 99, Booth and Tal, 2001, Antoniou and al. 2008, DeLong 2008, and Fan and al. 2012. These studies have tried to see whether the capital structure theories developed for the US firms are portable to other developed countries and to a small group of developing countries. But the empirical results in this earlier literature are based, as I said, on the analysis of large listed companies and thus the largest firms across the countries, which are not representative of firms in the developing world. So I will be concentrating on a few papers which are very close to our work. So the two papers which have written on the capital structure of SMEs in developed markets are the following. It's McNamara 2017, which analyzed the effect of country institutional setting on the SMEs capital structure decisions for a group of developed European countries, Austria, Belgium, Finland, France, Germany, Italy, Portugal, UK. And then again, the other paper by Jovier, which again examines the relative importance of firm-specific factors compared to country factors for a group of developed countries. Again, the sample of countries is similar to the McNamara study. Now, the two studies which are very close to our work, and I will be referring to them quite a lot in my presentation, are Jovier 2030, which analyzes the impact on leverage of firm-specific institutional and macroeconomic factors on a sample of stock market listed and unlisted companies in 9 emerging Eastern European countries: Bulgaria, the Czech Republic, Estonia, Hungary, Latvia, Lithuania, Poland, Romania, and Slovakia. And then the more recent study by Demirkul, Kunt et al. 2020. Thereafter, I will be referring to the study as DK and al. 2020. I'm a bit ashamed that I cannot pronounce the names correctly, given that my co-authors are from Turkey. But anyway, they have examined the capital structure of firms and whether it has changed during and after the global financial crisis, using quite a big sample of 75 countries. In our study, the question then is, what are we contributing to this literature? Well, we are using data from 24 developing countries with diverse country characteristics covering all regions of the world. And we focus on small firms less than 50 employees in developing countries. I mean, just by comparison, in the Jovier study and McNamara study, the SMEs have less than 250 employees. In the DK and TAL 2020, the average employment of SMEs is between 10 to 99. The size of the firms related to the impact of institutional characteristics and the economic financial environment of the country on the capital structure of firms. In order to answer that, this question, we'll be comparing the capital structure of small firms, medium firms, and large firms. Now, you might say, why SMEs? I mean, the previous studies, as I said, most of them concentrated on analyzing large listed firms. Well, for the developing countries, the SMEs constitute 67% on average of the formal employment in the manufacturing sector and contribute up to almost 50% on average to formal GDP in developing countries, according to Ayagari 2007. But of course, in developing countries, there is a huge informal economy. So if we take that into account, the figures rise substantially. So employment reaches 95% and GDP reaches 70%, according to Geske and Dahl 2007. The SMEs play a very important role in sustaining global growth in developing countries. They are the backbone of the corporate sector in developing countries and promote growth, employment, and poverty alleviation in the country. So that's why we are concentrating on SMEs. Now, what I have done here, I have tried to summarize, first of all, the factors that we will be examining which determine leverage. I will be, so in the first column, I'm listing all the factors, starting with the firm characteristics, tangibility, profitability, and size. And then we have the economic factors, which are the indicators that we are using, which have been used in other studies as well, are economic growth, GDP per capita, rate of inflation, interest rates. And then we are looking at the group of institutional characteristics, civil law, corruption, and then the group of financial environment, which are deposits, bank deposits, to bank deposits and central bank deposits, and this existence of a stock market and the turnover of a stock market. Now, in the second column, I'm going to talk about the expected impact of these variables, determinants of leverage, and then you can see in the next two columns what the two closest studies to our work have found with regard to these determinants. So let me give you some information about the expected impact of these determinants of leverage. Now, with regard to tangibility, we expect it to be positive because the higher amount of fixed assets, the higher collateral, and so the firms will be able to borrow more from the banks. Now, with regard to profitability, the higher the profitability, the higher the amount of retained earnings, and that if they have more retained earnings, they would be preferred to use those rather than debt and equity according to the pecking order theory. Now, with regard to the size, so we'll be expecting a negative, as I said, association between profitability and leverage. Now, at the size, well, the higher the smaller firms have opaque information which that cannot mitigate the information asymmetry. So there will be, the banks would be reluctant to lend to the small firms, as well as the fact that they would prefer to lend to the private firms and to the larger firms where there's a lot more information and it's cheaper. Now, looking at the economic environment, economic growth would expect a positive association because high economic growth implies good prospects, economic prospects, and of course that will imply good economic prospects for the firms, the small firms as well. So we'll expect a positive association. Now the next economic indicator we have used is GDP per capita, and that the higher the wealth of the country, and again, we will be expecting a positive association. Now, looking at the rate of inflation, again, we will be expecting a positive association because the higher the rate of inflation, the higher the value which can be deducted from debt, since given the deductibility of nominal interest rates. And the other indicator, interest rates, again, we will be expecting a positive association if interest rates reflect expected rate of inflation, because due to the Fisher hypothesis, then we'll expect again a positive association. Now, civil law. The countries have either civil law or common law, and we know that common law protects the shareholder much better than civil law. So the countries with civil law will prefer to, the firms, sorry, with civil law will prefer to, in a country with civil law would prefer to borrow money. So they would prefer leverage to equity. So would expect a positive association. Now, corruption, the indicator that we are using is as follows: the higher the value of the indicator, the better the corporate governance and the lower the corruption. So there will be more leverage. So that's why we expect a positive association between the two. Now, looking at the financial environment, now the deposit money bank assets to deposit money bank assets plus central bank assets, the higher this ratio, it means that the banks are playing a much bigger role in the financial system, so there will be more funds available to lend to the firms, and especially to the small firms. Now, the stock market, the existence of the stock market implies more financial assets, financial finance around, so we'll be expecting a positive association. Now, the stock market turnover, which is an indicator of liquidity, implies that the higher the turnover, the higher the liquidity of the stock market, so they would prefer to approach the equities rather than the borrow money. So they will expect a negative relationship. And as I said, the other two columns summarize the results of the two studies that are close to our study. And I will be putting our results in the context of those two studies. Now, our data, well, firm level data are from the World Bank Enterprise Survey, Investment Climate Survey, conducted for 24 developed countries, covering 5 regions of the world over the period 1999 to 2002. Unfortunately, the survey was not repeated, so we could not update our data, but that shouldn't be a problem because the decisions do not change over time. Now, the total number of firms that we have in our sample is about 10,839 firms, which include the total of small, medium, and large firms. Now, macroeconomic variables have been sourced from the World Development Indicators from the World Bank, financial environment variables from the Finance Development and Structured Database given in Beck and Tal 2009, while the legal origin of the countries is sourced from the Laporta and Ental 1998 and 2002. Now let's give you some descriptive statistics. I will be concentrating on the bottom half of the table. And there you can see that, as I said, the leverage for small firms is much smaller than that of medium firms and that of large firms. And the other thing, that I want to point out with regard to leverage is the fact that the average in our sample covering all the firms, the SMEs, is 39%, while just for comparison, in the US is 58% and in the UK 54%, according to Ryan and Zigales 1995. And the reason for this might be the limited availability of funds in developing countries to finance companies. The available funds are generally allocated, as we have already mentioned it, much more to the large listed firms, which are sort of 50%. Now our model. So on the left-hand side, we have leverage, which we measure as total liabilities to total assets. Then we have the list of firm-level variables, which I have already talked about, asset tangibility, profitability, and size. And then we have the economic environment variables, GDP per capita, economic growth, inflation rate, interest rate, and then the institutional variables, corruption and civil law legal system. And then the financial environment, which is the role of the deposit money banks to the financial system, and the existence of stock exchange and the stock market turnover. Now, let me tell you about our research methodology. We have estimated many models with somewhat different, minor differences amongst them. So in model one, we just examine the impact of firm characteristic on leverage, which is tangibility, profitability, and size. Then in the second model, we add country dummies. In the third model, we add to model one industry dummies. And then in the fourth model, we add both country and industry dummies. Then in the fifth basic model, we add our economic, institutional, and financial environment variables without any dummies. And then in model 6, we add to model 5 industry effects. And we use panel least squares with period fixed effects and clustered standard errors. Let's see what we found. The first thing we note is that across looking at the firm characteristics, leverage, we note that tangibility is negative or statistically significant across all models, which is, of course, in contrast to our expectations. We should have expected a plus sign, a positive impact. But as we will see, this could be due to the maturity of the debt. And it's something, this conjecture, we examine with regard to small firms later. So I'll talk again about that. Profitability is negative, which is in accord with our expectations and statistically significant. Then we find that small firms borrow less money, less funds, as we would have expected. And while large firms borrow, much more than the smaller firms. So again, that's according to our expectations. Now looking at well, before I go that, Okay, now I think I'll go through the characteristics and the country characteristics, institutional characteristics, and the financial environment variables, and then I'll talk about the R squared. So you can see that the GDP per capita is negative, which is against our expectations, we were expecting a positive sign, but that could be because GDP per capita might not be a good indicator of the wealth of the country. Then we have growth rate, which is positive and in accord with our expectations. So the higher the growth rate, economic growth rate, the higher the leverage. Then we have inflation, which is again, it's positive, meaning that, as we said, in accord with our expectations, the higher the inflation, the higher deductibility from debt, and so it's positive. While the interest rates, it's positive, which implies that it's when it's more expensive, the firms can borrow more. But that's not in accord with our expectations. We would be expected higher interest rate for firms to reduce their demand for funds. But anyway, it could depend on the fact that the higher interest rates might not reflect the expected rate of inflation, but other factors, for example, liberalization. Then we have corruption, which is positive, again, in accord with our expectations. Similarly for the civil law legal system. And then again, looking at the financial indicators, financial environment indicators, it's positive, the DPF, which is the importance of the banking sector in the financial system, and we find it to be positive in accord with our expectations. Similarly, the existence of a stock market is positive, and again, is in accord with our expectations. And then the turnover is negative, and as we said, the higher the turnover, the higher the liquidity, so firms might prefer to fund their expenses from the stock market rather than borrow money. Now let us look at what the various country and industry dummies do contribute to the estimation. And so, as we said in the first model one doesn't include any dummies, and then in model two we include country dummies, and you can see that the R squared jumps from 13% to almost 23%. So that's an indication that country factors contribute to the leverage, to determine the leverage of small firms, well, of the overall of SMEs. And then in the third model, we have added the industry dummy because the point why industry dummies are important, and we are using the World Bank classification to classify the various firms into industries, is because manufacturing firms would be needing collateral in order to borrow, while service firms will not be needing as much collateral. So that's why we include industry dummies. However, when we do include industry dummies, you can see that the R squared jumps from 113% to only 14%. So it's much lower than the contribution of the country dummy. So it seems that the industry dummy doesn't contribute into the explanation of leverage. When we add both dummies, country and industry dummies, then you can see that there is an increase of to 23%. So from 13% when there were no sort of inclusion of dummies, there is quite a big increase. Now, what do we do in Model 5? is, of course, not to include any country dummies, because we want to see whether our country factors can explain leverage. And you can see that, as we have explained, the impact of these country factors on leverage. But what I want you to note is the fact that the R squared is 19%, while if we include a country dummy, is almost 23%. So what that means is that our country factors cannot explain all the contribution of the country dummy. So there is still some part which is unexplained. And then the last model 6, is when we add the industry dummy, and nothing much changes. So this is for the overall sample of our, and this is really summarizing what I have already said. So I'm not going to go, I'm going to skip that. And this again explains what is happening with the R squared, which again I have explained it. And that again explains the impact of the indicators, both the country factors and the environment and economic variables, which we have already talked about. Now, the thing is, are small firms any different from large firms? And in this slide, I'm presenting the results of, we are repeating all the various models, but just for small firms. And what we see is that, again, the tangibility is negative and statistically significant against our expectations. And we are going to explore in a minute whether the maturity of the debt has anything to can explain that. While profitability is almost zero and not statistically significant. So that's really quite important. And then the impact of the factors of the environment, the economic factors, the financial factors, institutional factors, and all that, it's similar to the full sample, so I'm not going to go through it. And so this here we are going, the next thing we do is to see whether the tangibility, which is negative, statistically significant, reflects the maturity of the debt. Because for short-term debt, there is no need to, there is no need to use collateral, because it's trade finance, it's bank overdrafts, for which there might not be need to use collateral, as opposed to the long-term debt. So we are going to see whether what's happening to tangibility for short-term debt and long-term debt for small firms. So these are the results. This is for short-term debt, and you can see that for short-term debt continues to have a negative sign and to be statistically significant. And profitability, of course, not to be statistically significant. What I want to point out to you here is that we estimated this, all these models without the profitability, in case, since it wasn't statistically significant and the results do not change, the rest of the results do not change. Now, with regard to the economic variables and financial variables, etc., the impact remains the same and statistically significant. Now, let us see what happens to the long-term debt. So if you see a tangibility, it's now positive, as we would have expected, and statistically significant, and which means that for long-term debt, the tangibility, collateral is important, and the higher the collateral, the higher the fixed assets, the higher the collateral, and the firms will be able to borrow more. And so there are some small differences in the impact of economic and financial variables on leverage, but it's not anything to talk about. So here we summarize the effects. So in effect, yes, the negative tangibility, impact of tangibility that we find in the overall sample then reflects what's happening for the short-term debt. So the maturity of the debt is important for the impact of tangibility. So here we are looking to see whether, can't see the heading. Yeah, I think these are the determinants of the medium firms, because we are trying to explain, to answer the second question, research question, and so we are estimating the same models. No, sorry, this must be the results of the large firms, which are as opposed to because we want to compare the small firms to the large firms. And so we repeat the whole analysis, and you can see that the tangibility is negative, and profitability is statistically significant. But the key thing that I would like you to notice here is the fact that for large firms, the variables, the economic variables and the financial variables, and the quality of institutions, etc., are not really that important as they are for the small firms. So the environment does not really play a big role in the capital structure decisions of the large firms. It's what the firm needs that is important for their capital structure decision. And this is what we are summarizing, what I have already mentioned to you. So I'm going to skip that. Here we are going to come to try to answer the second question, whether the size of the firm matters for the impact of the environment, economic and financial environment, and institutional quality factors. So what you see here is that the tangibility has a negative impact. Profitability is important, so they're behaving more like large firms. But the capital, all the country characteristics, environment, financial environment, economic environment, institutional characteristics, quality of the institutions, their impact is the same as that of the small firms. However, there is a small difference with regard to the results of the small firms. What the various factors, country factors in Model 5, which explain leverage, if you look at the R squared, they only explain 10% or almost 11% compared to the R squared of 18% for the small firms. So that tells us that the size of the firms does matter for the impact of the country characteristics. So that answers the second question we set out to answer in this project. And this is what is really summarizing what I have just said, that the R squared is lower in the medium firms compared to the small firms, implying that the macroeconomic, institutional, and financial environment variables contribute less confirming that the impact of country characteristics varies with the size of the firm. Now, okay, let me summarize our results. We have examined whether the findings of the earlier studies on capital structure decisions apply to the very small companies in developing countries smaller than the ones examined in previous studies. And in order to show to you that the size of our firms is much smaller than the previous studies, I've taken the examples of Booth et al. 2001, and they include in their sample of countries both India and Pakistan, and we include both of those countries in our sample, so we can compare the size of these small firms in these two countries and in these two studies. So the total sales in India is $98 million, in Pakistan is $27 million. However, in our study, total sales in India is $10 million, and in Pakistan is only $1 million. So you can see that our firms are much smaller than those in other studies. Now, looking at the DK et al. 2020, where they report the average total assets and sales of small SMEs for both developed and developing countries together, and they report that they are $60 and $120 million respectively. In our study, total assets are 10 million and total sales are 4 million for SMEs in developing countries only. So you can see that the size of the firms we have examined are much smaller than those examined in previous work. Furthermore, previous studies have used a smaller number of countries. For example, in Booth et al. 2001, they have used 10 countries. Jovier have used 9 Eastern European countries. And DK et al. 2020, they have used a much bigger sample, but the developing countries are not representative of the whole world. In our sample, we cover all regions of the world, which have allowed us to arrive at more conclusive results because there will be more diverse, they will have more diverse environments and institutional characteristics. So bearing that in mind that we have examined very small firms and for a large sample of developing countries covering the whole world, we have found the following. The size of the firm is an important factor in the level of leverage. Profitability has no bearing in capital structure decisions of small firms in contrast to large firms. But this is in contrast to the findings of Jovier 2013 and DK et al. 2020, where profitability is found to be negative. The conflicting results might be due to the fact that the size of our small companies is much smaller than in either of those two studies. Now, tangibility impact is negative for small, medium, and large firms. A similar result is found in Jovier, and in DK, the relationship is positive, so our finding is in contrast to the expectations where we should have found that we expect a positive relationship. However, we have examined whether this is due to the maturity of the debt, and indeed, the impact of tangibility on short-term debt of small firms is negative, and on long term is positive, according to expectations. And I explained this could be the reason that for short-term debt, collateral is not important. I mean, they use bank overdrafts and trade finance, which might not require collateral. The country of incorporation is an important determinant for the debt financing decisions of small firms. The financing decisions of small firms are sensitive to institutional characteristics and the macroeconomic and financial environment variables of the country, while that is not the case for large firms. This confirms the results of JGBS 2013, who found that country-specific factors are in the main determinants of variation in leverage for small unlisted companies, while firm-specific factors explain most of the variation in leverage for listed and large unlisted companies. Excuse me. Further analysis on the determinants of leverage, we find that medium-sized firms in our sample established that the impact of institutional characteristics and macroeconomic and financial environment variables of the country is similar to that of small firms, but the R-square is smaller, implying that the impact of those variables change with the size of the firm. This could explain why our results concerning the impact of country of incorporation are similar to JGBS 2013, despite the fact that the firms in that study are much bigger. So finally, just to sum up, our results show that the capital structure decisions of very small firms in developing countries are different from those of large listed firms in developed markets and bigger SMEs in developing countries, which was the main question we set ourselves to answer at the beginning. So that completes my presentation. I have to just one more thing. We have done, we are in the process of doing some further work, which I've not included in the presentation, to explore whether regional factors, because as we said, our sample of countries cover the whole of the world, all the regions. So we wanted to see whether the regions contribute to the explanation of the leverage in SMEs in small firms in developing countries. And what we found up to now is that the regional dummy adds to the explanation, but it's much less than the country dummy, i.e. that the country of incorporation continues to be the main sort of contribution to the explanation of leverage in SMEs in developing countries. So I'm happy to answer any questions that you might have.
Thank you so much, Professor Kate, for such an insightful lecture. Does anyone has any questions? Professor Kate, I have one question. Actually, how you classify the firms into like large and small firms, like on the basis of top 33% or bottom 33%? I would like to know more about your classification of firms.
The classification of firms, we have classified them according to the number of employees. So I thought I mentioned it. These small firms are up to 50 employees. The medium firms are between 51 and 500 employees, and the large firms are more than 500. So it's that was our criteria for dividing the firms into small, medium, and large firms. I have to admit, one issue that we are trying, and I'm not sure whether we'll be able to really to explore that in great detail, is the ownership of the firms. Because family-owned, what we believe is that family-owned firms will not like to go and borrow money, because that will dilute their control of the firm. So we have some information on the ownership of the firms, but I'm not yet sure whether it's extensive enough for us to explore that avenue. presumably in India, don't you think that that will apply to the firms in India? That there are a lot of small firms where the owner is a family. I mean, the manager is a family member. So it's, I mean, I see it from I come from Cyprus, and my father had printing works, and I see how they have managed it. They wouldn't like to borrow money or to have someone else coming into the management of the firm. So they wanted to keep control of the firm.
Exactly.
So I suppose that will apply to small firms in other countries as well.
Okay. Thank you so much, Professor Kate, once again. It has been absolutely an honor. And thanks to all the attendees. Thank you.
Thank you very much for giving me the opportunity to present our work. It's still, I mean, we are still in the process of revising it. So if anybody thinks of a question, they can send me an email, because we, as I said,
there is one question from Muhammad Aftab. Do you expect those results are subject to change in current pandemic era?
That's a question. I mean, I wouldn't say, I mean, as a result of the pandemic, if anything, due to the quantitative easing in the US and in other advanced economies, there should be more plentiful funds. So perhaps it's very difficult to say, but possibly it would be easier for small firms to borrow, because there'd be an increase in global liquidity. In global liquidity, I mean, it's not both affects all the countries. So possibly it would be easier for small firms to borrow. I don't know, has India reduced, I mean, increased, tried to, with regard to economic activity, because obviously economic activity must have been affected by the pandemic. Is it really applying any expansionary fiscal policies, anything which will reducing interest rates, which will help the firms to borrow more money, and especially the smaller firms?
Okay. I think these are the only questions we had for the day.
Okay. As I said, if anybody of you thinks of a question and would like to ask me, please send me an email or any comment. I would be very happy to take it on board. Thank you very much for giving me the opportunity to present our work, and I hope on another occasion I'll be there in person.
Thank you so
I
much.
will meet you all in person. Thank you very much. Thank you, Professor Sen, for inviting me to this series of lectures. Okay.
It's been an absolute.
Thank you very much. All right.